What if I told you that the difference between saving tens of thousands of dollars in taxes next year and overpaying the IRS as an alternative could come down to one simple thing, and that is how your income is classified. Tonight it's time for real estate tax strategies for 2026. Look, I know it's November, haven't even had Thanksgiving, but we got to be planning ahead. I'm bringing in one of my favorite experts, Greg Taylor from Taylor Tax Strategies. So, a couple of things we're going to cover is whether you're a renter or a landlord dealing with cash for keys buyouts. We're going to talk about that. Basically, discussing whether that relocation money is taxable or not. And then we're going to talk about how to offset passive versus active income and some strategies for that. This is the hour that could completely change how you approach your taxes for 2026 and beyond. We'll even walk through this amazing spreadsheet that Greg has where it shows the different types of income and how they're taxed and a few simple tricks you can do to minimize that. We'll cover that. It's pretty nerdy but fun. And so this is how folks are minimizing their taxes. So it's time for the 2026 tax saving hour. We got Michelle in the background, so make sure you put your questions in there and we'll get to those as those pop up. You're going to get insight straight from the tax trenches. Remember, I can't give tax or legal advice. Greg can give you tax advice. But I'm here to help answer your questions. Landlords, renters, investors, want to be investors and more. Without further ado, there he is, Greg. How's it going, my friend?
Hello, hello.
Are you ready for Thanksgiving?
I'm getting there.
It's late this year, which doesn't help. When it's that late, well, and the downside when it's that late too is it's basically you don't have much time to do your Christmas shopping because Christmas comes quicker when it's this late. So just a reminder, make sure you get something nice for the wife. My wife already got herself something nice today. I just found out, so that's good. I'm covered. So, hey, appreciate you being here. I know it's late where you are in lovely Louisville, Kentucky, and you guys have an amazing setup there. I've hired you to help me with my taxes, and you guys do bookkeeping, you do taxes and tax strategy, and your focus is real estate and business owners. And we appreciate you being here this late at night. So let's dive in, my friend. So first thing, we want to discuss our cash for keys. This came up. It was a good question. I can't remember if it was a renter or a landlord asking, but is that taxable income? So let's start with the renter. So let's say a renter in exchange for, I gave a check for $50,000 once for a rent stabilized property in LA. So let's say a landlord is giving a renter $50,000 to move out. Would that be taxable for the renter? And how would they handle that?
Yeah, so technically anytime it's over that 1099 amount, it's going, or I'm sorry, over the $600, it's going to be taxable as a 1099.
Got it.
So yeah, so we are in a spot when you're talking those kind of dollars, it's going to be really hard to get the information of the tenant. If they're already not cooperating by moving out, they're probably not going to give you their social because
It
they
is a
might think you're
tough
using it
ask,
for
I'll
other
tell you.
purposes.
Yeah, I've been there. Now, when you're getting a big check, it's just you just pitch it as, hey, this is what you need to get your big check, but you don't always get that. So the
Yeah, that's
renter,
true.
they should declare it no matter what, right?
The renter should be declaring it, yes.
Okay. And then the landlord, if they do get a 1099, what are they able to then write that off? How do they handle that?
So the landlord would be issuing the 1099, and that would be something that they could potentially write off if they've issued that 1099.
Got it. Yeah, I'm saying it wrong. Yeah, the landlord issues the 1099. Which one would it? Any idea what it would be? Because I know there's different ones, like 1099 miscellaneous or something. Maybe I don't know.
Yeah, I would say that would fall into the 1099 miscellaneous.
Yeah, and then if a landlord isn't able to get a social security number to issue a 1099, any strategies there you'd suggest for the landlord?
So I would still issue one just without it, and I would say that we couldn't get the information.
That's good.
Yeah.
That's a good
So
tip.
there are ways to do that.
Yeah, and it's especially the larger amounts. Like I was this one, like I said, it was 50,000, and we gave it in two different payments. First in 10, so that she had money to move out, and it was also good faith to know that look, we weren't just negotiating a fake deal. And then 40 at the day she moved out. But that's I think that's an important thing, and we're going to potentially start to see that more because I've done some investigation into foreclosures, and looks like those might start to spike as well. So what happens in that
Yeah.
case is for properties foreclosed on, and then a real estate agent shows up and offers cash for keys to move out. So
Yeah, yeah, that's definitely a tactic that a lot of people are doing, and I think you're just gonna have times where that's gonna be hard to get the information to issue the full 1099.
yeah. All right, so let's dive into the passive income versus earned income. I guess technically is what you'd say, but you could passive versus active income is what I've been saying. Let's start to talk about that. And I know you have your amazing spreadsheet, so hopefully, without too much technical difficulty, we can get that thing up. Because I learned a lot when you showed me that thing. You've showed it to me a couple of times while we were having our meetings together, and every time I'm like, Greg, we got to go over this in a live stream. So,
Yeah, I actually just sent it to you since my computer is giving me a little bit of problems. If
yeah,
you want to pull it up,
yeah,
then we
perfect.
can look at it from your computer. Maybe
Let's
that'll
do
help
that.
us.
Let's do that. So now, any technical difficulties, it's my fault. It still hasn't come through yet. I'm sure it'll be here in a minute. Anything new since we talked last? I know we're all continuing to digest the big, beautiful tax bill more and implement. So, and maybe by now it's easy for you. Like it's just nothing. You've got it all digested. Any updates there on the big, beautiful tax bill?
Yeah, most of the things on the big beautiful bill that we're using involve that depreciation, the some of the bonuses and stuff like that. There's the stuff with the employees that are getting their, no tax on overtime and tips, and then there's the some changes to the energy credits that basically are out there. So
Yeah, I was
those are the
disappointed.
big
I
things.
did when I did my house. I sold my house this year, and we did new windows as part of it because it was a major remodel. The whole time I'm thinking, "Oh boy, I'm going to save a bunch of money with these new windows," and it was like I forget, it was like $600 or some ridiculous thing. So I don't feel like I'm going to miss that. That
Yeah, it's not very much, honestly.
yeah,
So
it was disappointing. Okay, so I pulled it up. So we got the different income tax buckets. So let me zoom in on that a little bit more.
yeah.
So you got active versus passive. Perfect. All right. So and, and this big red
Yeah, yeah.
do
The
not
big red
cross.
line is very important.
Tell me what the heck's going on here.
Yeah, so basically, there's two main categories of income that the IRS has for your income sources. And so you have your active, which is money that you earn from like work that you do. So we have on that side the W-2, the 1099. A lot of real estate professionals are doing Schedule Cs. If you have a partnership and you're getting paid for your contribution into the partnership, for example, I have a flipping partnership, and the partner that manages the flips as they're happening gets $100 per week per flip while it's going on, just as kind of an acknowledgement that he's managing it. So that's a guaranteed payment that can happen in a partnership. And then there's something called mark to market election, which is down there at the bottom. I'm skipping the two in yellow for now. Mark to market
Yeah.
election is if you are a basically daytime trader of stock or crypto, you can actually get a specific election for that.
That's fascinating. And that's becoming more popular, especially because a lot more people are dabbling with crypto.
Right.
Do you, sorry, I keep interrupting. Do you play with crypto?
Not really. I mean, I have, everybody's got a little bit in their Robinhood account or something, but I'm not actively doing anything with that.
Okay. Just curious. I haven't played with crypto at all yet. So
Okay.
anyway, I got to figure out another good way to lose money like crypto. But
Yeah,
all right.
so
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 yeah,
that's the
keep
active
going.
side, and then our passive side are things like interest income, dividends. So if you have interest from your bank account or stocks and or bonds, things like that. and then dividends from stocks. Profits from an S corp are kind of an ambiguous type of thing. Um, and then yeah, stock and crypto trading generally would fall into that category if you're not mark to market. And so the big difference here is that what it says on the bottom there, income tax at current rates, 15.3% self-employment tax. So
Hmm.
your active income is taxed for self-employment purposes, or I'm sorry, for Social Security purposes. And so that's where the active income can really be a negative for you, because basically anything you're earning is going to be taxed for Social Security up to 178,000.
And this is specifically for the self-employed. They're the ones who have to worry about the self-employment tax. So if you're pure W-2, that's partially paid by the employer, correct?
Yes. So if you're pure W-2, half of your Social Security is paid by the employer, and the other half is paid out of your withholding.
Got it.
Yep.
Okay. The stuff in yellow, why do we have the same stuff
Yep.
on two different
Thank
sides?
you very much. So that's what we use for real estate. So that is how we can move the income from one bucket to the other by either qualifying someone as real estate professional or not, which is that first one, real estate rental real estate if rep stands for real
Got it.
estate professional. The rep does. So if you have rep status, then your real estate transactions, anything you're doing in real estate. So, like for you, Christian, any of that stuff is moved over to active for you, which means if you
Yeah.
have profit, it's subject to self employment tax as well. So, you're paying Social Security and Medicare tax then on that real estate professional income.
Got it. And then, sorry to interrupt again, but for me, this year I sold my home. So I have capital gains tax, some of it offset by Section 121, but that'll fall on the passive side, the
Correct.
gain
Because that
there,
was your
right?
primary residence.
Correct. Yeah, exactly. Good question. It wasn't an investment property. So yeah,
Right.
so as a real estate agent, I've got the income because I'm representing buyers and sellers, and then I have that as well. This is cool. I really keep going. I love
Yeah.
I love how you're breaking this down. And then
Yeah.
do
So,
not cross. What is that all about?
yeah, so that's the thing. So if you have this passive income or loss in the case of real estate, because a lot of times we do my favorite, the cost segregation, which I can't talk to you without bringing that up. But we do things like
My
cost
favorite.
segregation, bonus depreciation. We have big repair bills on a property as you're getting it up and ready to go, and that is going to be on the passive side unless you qualify as a real estate professional. So, for example, I have a client who is a doctor, and so they make really good money, but it's W-2. And some of it's
Yeah.
1099, but all of it's on that left active side. And so buying rental properties that are long-term rentals for them, there's no way for them to actually get the benefit of those long-term rentals against their W-2 and 1099 income. But it's in
Got
yellow
it.
because if we get their spouse to qualify as a real estate professional, or we do short-term rentals instead of long-term rentals, we can move that back and forth. And so then I have another client who's looking at some different sources of passive income, and we might move them back over to the passive side on their real estate, get them out of real estate professional status so that we can qualify them for those, again, the income to be offset by the losses from the real estate.
Yeah, so and I'm dumbing it down because I'm a dummy when it comes to this stuff. So obviously, passive losses can offset passive income, but what we're figuring out a way with being a real estate professional, and we'll talk a little bit more about that in a minute, is a way to get passive where you want it and active where you want it, so you can offset income. Is that
That's exactly right. Yeah. And so the other one that works really well is the short-term rental. And so the
yep,
short-term,
STR?
yeah, the STR. So short-term rental loophole is what it's known as. And if you look over on the right there, down at the bottom, it says STR loophole. And
Oh
so
yeah, yeah, yeah,
the three basic steps there, yeah, you can highlight it or something if that'll work for you to highlight.
yeah.
Um, But so basically, the 3 steps there is you have to spend 100 hours working on that property. No other one person can spend more time than you do. So a property management company would spend, maybe they'd have a cleaner who does it, this many hours per year, and they have then a person who interacts with guests at this many hours per year or whatever. So you have different people doing different parts of the job. So you can have a property management company. The only thing I always tell people, you need to be cautious if you have a property manager who does it all themselves, because they could very quickly get more hours worked on that property than you have. And then the
Yeah,
third one there is an average stay of less than 8 days. Now I'll hear
that's
from some
interesting.
people, they'll say, well, what, I have somebody staying for 30 days. And I actually do. On one of my short terms, I have somebody who's booked the whole month of March. And so they will be there. But as long as my average stay is less than 8 days, then I'm good. So I have a lot of weekend through the winter. A lot of people are just coming Friday, Saturday. So they're just there through, for 2 nights. And so that will average out on that 30-night stay.
That's smart. And that's good too that you're making people aware of that, because you got to manage that. Like as you're getting later into the year, you might have to say, sorry, only short stays for folks
That's
so you
right.
can get to
That's
that
right. Yeah.
average.
Or you
And
might need to, not allow bookings more than 2 weeks or something like that. So
yeah.
you really just
Yep.
kind of gotta look at that throughout the period, and make sure you're not getting super close to that. So
And real estate professional status. Let's talk about that.
yeah, so that's what you are, because you are doing real estate full time. So in order to
I'm
call,
doing 750 hours per week. Does that count?
yes, 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 that's
I
right.
exaggerate, but no,
Yeah,
it's
feels like
a
it, right? Some
full-time plus.
weeks. Yeah. So 750 hours per year spent on real estate, 51% of your working time and 51% of your earned income. So the majority of your time working and your earned income time. Now, 750 is about 15 hours per week if you divide that out. So it doesn't mean
Okay,
that you can't have another job, but you can't have another job working 20 hours a week. You could have another job working like 10
got it.
hours a week. So you're really
Got it.
saying that you're devoted to real estate.
Okay. And that means when you say devoted to real estate, you are helping others buy and sell? I mean, could you do it for yourself?
Yes,
Like,
yeah.
give us
So
some examples.
wholesalers qualify. You can do it for
Okay.
flippers qualify.
Okay.
If you're even construction, like home builders, people like that qualify. I have a lot of builders. It says anybody who's
Interesting.
improving.
Subcontractors?
Yep, subs would qualify as well. So electricians, plumbers, if their main focus is improving properties, it gets a little vague with those. But the way I read the code, I would push for that, and I would just talk to my clients about it beforehand. So,
Yeah. See, what's fascinating, those folks you just mentioned, wholesalers, flippers, subcontractors, contractors, none of those are licensed real estate people. They're not licensed in real estate, I
that's
should
right.
say. That's fascinating. So I appreciate you bringing that up, because people may not immediately think of that as a real estate professional.
That's right. Yeah,
So
I have some clients who are like, "Well, I'll just get my license, but I'm not doing anything else in real estate." Because I have my other full-time job, and that does not get you there either. So just because you have a license does not mean you are a real estate professional. Which I think is kind of using the term to mean something else, because typically the word professional means you get paid to do it. But
yeah, well said.
so yeah, so I think it really depends. There are some real estate agents, honestly, if you look at statistics, who have a year that they don't sell a house at all, but they might still be a
Yeah.
real estate professional because they worked more than 750 hours in the business, even though they didn't use their license to transact on behalf of someone else.
Yeah, my business, you can do a whole lot of work and not actually sell
That's
anything.
right.
So
Yeah, my
that
mom's
does
been an agent my
that
whole life, so I have seen that plenty of times.
you know,
Yes.
Greg, you grew up around that. So let's go back to the income tax buckets. Um, so where do you want to head next? Because I know we got some
Yeah.
numbers over here on this side.
So that right there is actually about the S corporation. It's just something that we talk about a lot in my calls. It's not necessarily related to the active and passive, but it
Got it.
does show you a little bit of the difference between how we can use these to differentiate. So if you do not have an S corporation, which you'll see that on the right side on line 8 under passive, it says profits from S corp draws / distributions right there. Yep.
Yep.
If you do not have an S corp set up, then all of your income is going to be that Schedule C, which is on line 6 on the active side. Yep. And so if it is that way, let's say that you had a profit of $168,000 over there on F5, the
Yep.
business profit
Yep.
168, you're going to pay Social Security tax on all of that at 15%, roughly 16%, right in that range. I think my formula
Yep.
is 15.6 or something. I can't see it on this screen. It's a little small, but somewhere right in it. Yep, 15.3. There we go.
There
And
you go.
then the income tax you're going to also pay on that, which I just have a number of 0.2 in there kind of as a marginal rate. So your total taxes, if you don't have the S Corp set up, are going to be just under the $60,000 if that's your profit from your business that is a Schedule C.
Got it.
So
So
then
that would be a real estate agent who is not a Schedule C or an investor.
exactly.
I'm sorry, a real estate agent who's not an S corp, or an investor who's not an S corp, or any other business.
That's right. Any type of business. Yeah. Consultant, if you're a plumber or electrician and you're doing it on the side like that, and you just have a
Yeah.
Schedule C. So once that profit typically gets over around 100,000, we look at moving to an S corp. So in this situation, we take the effects of moving that 168 to an S corp. And so we have to
Got
do
it.
W-2 wages. The IRS says that you have to do what's called reasonable compensation, but they don't define what reasonable is. So
Yeah.
we have to kind of define it. So if we split that and we say 80,000 is your wages for earning money in your company because you're actually working in the company, and then we say
Yep.
88,000 there, that bottom number is what
Yeah.
you made because you own the company. So that's your profits, which is again that line under passive, the line 8 that says profits. So we're saying basically your earned income is 80 and your unearned income because you own the company is 88, which gives you the 168. You still pay Social Security taxes on the 80,000, but you don't pay it
Got
on
it.
the 88,000. So
Because this is an S corp
exactly,
distribution.
because then that became
Yeah.
like passive income. Even though you're active in your S corp, it became like passive in the fact that you don't have to pay the
Back
Social
here,
Security
back in your
taxes on it.
passive
Exactly.
profits from S corp. Okay. This is perfect. I'm actually starting to understand this stuff.
Okay, good. I'm
This is
glad you're
good.
driving. Maybe that's helping to click back and forth and point it out.
That's what
So good.
everybody you need to give this to everybody
Yeah,
to play
maybe I
with.
should let
We're gonna
you go
make it
through it instead
we're
of
gonna
be
vibe
be
code
the
an app.
pointer and I just explain it. That'd be good. So then you have your income tax that you can see your income tax adds up to the same. You have the 16,000 plus the 17 equals the 33.6. So those two numbers
Interesting, yeah.
together add up to the same. You're not saving
Yeah.
on income taxes, but you're saving on that Social Security tax. And so
Got it.
if you look there at the difference, the combined tax, if you do the S corp, is 45 instead of the 59. So then we've got S corp savings there of 13,000.
Does that affect your down the road? Well, I mean, who knows if Social Security will be around
Sure.
in 20 years, but does it affect your disbursement down the road
It
potentially?
definitely would because you are paying in less. So in option 1 there, where you're just a Schedule C and you have the 168,
Yeah.
you're basically maxing out Social Security contribution every year. 178 is the top of the line for Social Security this year. It normally goes up a little bit every year, but 178 is for 2025. And
Okay.
so you're pretty close to maxing it out. And the way Social Security is calculated currently, it's like your highest 35 earning years is what they use to calculate it.
Don't scare me. That sounds
Yeah, yeah.
so long.
Exactly, exactly. So like my dad, for example, who I've mentioned on this program, he was looking to retire, and so we were talking. He was like, "Should I retire at the beginning of December or the end? Like into January." This was last year, and I said, "Well, if you're looking at Social Security at this point, if you stay one more month, you're going to drop off your next lowest earning year and have a really high year because typically towards the end of your career is your higher years."
Yeah.
So it impacted him fairly significantly monthly to finish out the year because then it was a higher earning year instead of having 11 months in that last year. So he stayed around a little bit longer. in order to do that.
And that right there further reinforces why you need a tax strategist like Greg Taylor. All right, so let's all nighters hanging out with us. Thanks for being here, bud. He wants everybody to hit that like button, like Cheech and Chong, to show the algorithm what's up. We appreciate that. And all nighter was talking about reasonable wages as well. He found comps from similar services are required. What do you do, Greg, to help with reasonable wages, which is what we were talking about here? Back under the W-2 wage section.
That's right. Yeah. So reasonable compensation. So I will say this, the IRS has never lost a case when they have challenged someone's reasonable wages. If the taxpayer has chosen to fight the IRS is batting 1,000 on
Oh,
that.
geez.
So I don't encourage getting, close to that line or trying to argue with the IRS on that. I encourage you to just keep it in a non-flaggable number. Even if you're paying a little extra in tax, you're still getting a benefit. So even if we bumped that up, to 100 and it was 68 in the where the 88 is,
Yeah.
if that's going to keep the IRS from coming knocking, it's worth it, and you're still getting some tax savings there. So so I always encourage people to not be too stingy with that number. I've had some clients say, well, maybe I could do 40. And I'm like, yeah, maybe you could, but you had $1 million in profit. So I can pretty much bet you're going to get an audit. I'll actually take that bet. So
Yeah, here, I'll hand you your red flag
right.
so you can wave it.
Exactly. So yeah, if you want to just wave that flag and run down the street and let them know. But yeah, so I had another client actually this week. They were like, do we need to bump it up more because we don't want to have that issue? And they're at 6
That's
figures
good.
already. So I told them I thought they were fine. Now there
Yeah.
are companies out there, and this might be what All Nighter was talking about. There are companies out there that do reasonable compensation studies, and they'll actually interview you and say, okay, how much time do you spend doing this? How much time do you spend doing that? And especially for like 1 or 2 employee companies that have just switched to an S-Corp, you don't have a lot of like extra employees yet. You'll have some of your hours to be like at an admin rate, which is maybe 15 to 20 an hour. Well, in California, it might be more, but in the Midwest, 15 to 20 an hour.
It's
And then you'll
$20 an
have,
hour at a fast food
you'll,
restaurant now.
yeah, exactly. And then you'll have some other things that are at like a consulting rate or, a higher wage pay. And so they'll give you a number kind of based on all the different jobs you're doing in your
It's like
company.
a
So
cost segregation job study. If
that's
we can
exactly
use
right. Yeah.
All Nighter has a good point going back to your dad. This is about his dad. So his dad earned about 70K in 95, adjusted for inflation is about 212 a year now. And that's a good point, is don't forget inflation. So going back to picking the 35 years, like what your dad did, he may have been making good money 36 years ago, but
Right.
once you adjust it for inflation, it's not a big number anymore. So that's a good point,
That's right.
All Nighter. All right, so let's see. On here, we got one more thing on here. We're talking about property price minus land bonus
Yeah, so that's
depreciation.
my favorite. That's just the little cost seg estimate, which is another thing that people often ask about.
Yeah.
So basically, we take the property purchase price, do 80% of that because you take 20% off for land. Generally, I know in different areas of the country that's different. And then we multiply that number by 0.25 or 25%, and that gives us our bonus depreciation deduction. So
Yeah. So, and we've talked about that before. It depends on where you are,
that's right.
for the cost of the land. Like in California, a lot of it's in the land, whereas by you guys, tell me, I always laugh and get shocked. Tell me what you paid for that 5-unit again.
135.
135,000 for the whole
Yes.
thing.
For 5 units and the land it was on and the garage.
And how much you make in income? I know we talked about this, but I got to hear this
Yeah,
again.
it brings in between 3 and 4,000 a month.
Okay,
So
see,
obviously I have my payment on it, and other
yeah,
things like that. But
I
yeah,
just want to do this again. I know we did this before,
yeah,
so I'm going to use 3,500 for your gross scheduled income times 12, so you're about 42,000. I'm going to use 30% for expenses, So about 29,400. We're doing the cap rate, so we're not including your debt service. And then you paid what did you say? 135?
135. Yep.
Okay, so your cap rate that's a 21% cap rate. That's insane. Anyway, 22%. Okay.
It was a
Sorry.
really good deal even for here. I will admit that, but there are deals like that to be found in the Midwest for sure.
So, and that in your case there, if you can share if you've done it, like what did a cost segregation study show
I couldn't
your
even do it. It was
Oh
too
yeah,
cheap.
that's right. We talked about that. Did it make sense
Yeah,
to
it
do that?
doesn't make sense typically unless your building value is over about 180. So
Okay, so 180 or more do the cost seg because you're going to unveil or unearth some additional depreciation.
right, and it costs to do the cost segregation. So yeah, so that's where, yeah, it doesn't make sense if the all-in price minus the land is too low because basically everything you're saving in taxes is going to pay for the cost seg study. So it's a net nothing basically.
That's good. I hope everybody else is finding this as exciting as I am. I got to tell you, Greg, I knew nothing at all about any of this. I know it's embarrassing as long as I've been a real estate agent helping people, but I just never wrapped my head around this stuff. And with you, I've learned so much. So thank you for this.
Good. Yeah, I'm really glad to hear that. It's not you're not the only real estate agent or realtor or real estate professional who's been in that spot. So
And a part of it is not, I like to leave things like this to the professionals. Just like I have good eviction attorneys, I'm not gonna learn the whole eviction process. I got good eviction attorneys. I'll learn enough to know when I need the professionals, and that's with you, I feel like I've learned way more and know exactly when to turn to you, so that's helpful. Let's go back to the active versus passive, run through some other tricks here because I keep interrupting you because I'm so
yeah,
excited.
so no, that's okay. So I really love for anybody who has active income and doesn't get to real estate professional. I really love the intentionality of that short-term rental loophole. Um, there is another way to do the short-term rental loophole. It's a little bit more hoops to jump through, if I can keep using that analogy. But
Yeah,
basically, if your average stay is 30 days or less, and you provide substantial services, such as like what a hotel would do. So maybe you're doing linen changes every day, or excuse me, something like that. So in those cases, then you can get that short-term rental, even if your average stay is over that 8 days.
got it. Okay, so it's not completely dead, but it's important to talk to you to strategize to figure out which path we're going to take.
Right, to make sure, and it's definitely gonna be harder to prove, the other thing, but, like, what I do with my clients is we're talking through, like, okay, how do we document that 100 hours? How do we ensure if you have a property manager that they didn't go over it? What information are they giving you that states that they didn't have anybody spend more time working on the property than you? We also look at I have a lot of clients buying right now. I have clients who are closing this month on properties. So then it's very hard for someone else to spend more than 100 hours working on that. And if they only get one stay in this year, they just need to make sure that one stay is less than 8 days that they get in. So, um, and getting 100 hours, especially if you are buying something out of town, is not very difficult. You and your spouse's hours can combine. So, like, for example, we have one in Myrtle Beach. My wife and I flew down there once together, and then flew back. So we have four, legs of travel time there. And then I've flown down there myself twice. So I have two more on each one of those trips. So I have four by myself, and then my wife and I have four together down and back. And so we're just counting 8-hour days for each one of those. So 8 times 8 is 64. So we're already at 64 hours just from the travel time to get there. And then we met with our property manager one day while we were there. I did the lending and all the other stuff. So getting to that 100 hours is pretty easy.
That's a lot of good tips in there, because that's what I was looking at too, especially if it's later in the year, how are you going to get that 100 hours? But no, you gave a perfect example. Now, for me, being a real estate professional already, or like we talked about, a wholesaler, a flipper, contractor, subcontractor, it doesn't. If I have a rental property in Myrtle Beach where I'm competing with you, it's going to be nicer than yours. If I have one in
Yeah,
Myrtle Beach, it's not like I have to do anything for that property in Myrtle Beach because I've already qualified
that's right.
on this side of things.
Yep,
So
you're already a real estate professional. So we're going to do a grouping strategy where we group all of your rental properties together.
got it. No,
Yeah.
this is so friggin' helpful. Thank you for doing this. Thank you for
Yeah,
going
yeah.
through this. And I know we
Yeah,
did
it's
this,
really
but
huge for high earners who are who are W2 or 1099 if you have a business there. It's also, and you can do it on the short-term rental, or you can get your spouse to qualify as a real estate professional. So I could probably, without a lot of effort, get my wife to qualify as a real estate professional. She manages a couple properties. We have some that we own locally, so we could probably get her there. But I just haven't gone down that route because we have enough other strategies that I haven't needed to, and I don't really want to go to my wife and say I need you to work more unless I really need her to. So
yeah, that'll be the most expensive employee you've ever hired, is my
exactly,
guess. She's
exactly.
going to make
So
sure. All right, All Nighters got something here for us. Uh, um, yeah, so basically All Nighter, you're working to get your hours in with the travel, which is good. Did you All Nighter? Did you actually close on that portfolio? Because I know you were going to buy it from the owner in Gary, Indiana. We didn't get a chance to talk about that. So, yeah, so just traveling there and back is going to help All Nighter get that.
yeah,
Um,
yeah.
does a does a YouTube channel focused on real estate count for real estate
I would
professional?
count it. So if you go to the IRS website, it's actually a little ambiguous, and I may have shared this on one of the other programs, but real estate broker, I'm sorry, mortgage broker or commercial lender is not listed as a real estate professional.
I remember you said that, which is crazy. So
It
they'd
is.
have to figure out a way to qualify differently, even though they're
Yeah,
doing
I
it
think
every
they're
darn
trying to
day.
say they're in banking or finance and not real estate. I think that's the IRS's implication there. Um, but I would, with my client's education and permission and understanding, I would be comfortable arguing that they're a real estate professional as well, because it's not disregarded. It's not said that it can't be.
Yeah,
It's just not one of the ones that is included in the list.
yeah. It's not a no. It's not a
Right.
yes.
It's
But
a no comment. Yeah.
exactly, exactly. I could.
But
There's
I would
some.
definitely and have told clients who are in that spot, "Hey, we can do this. I think it makes sense. I think it's fair.
Yeah,
You're buying real estate, you're doing loans, like I think you qualify." But the IRS has left that off of the list.
got it. So All Nighter, that portfolio is in San Diego. He's working on getting that closed. So
Okay.
All Nighter, make sure you talk to Greg once you start getting this real estate everywhere, so you can save even more money and do your cost segregation.
Yeah, we
I
gotta get
just
those
laugh
cost
and think
eggs
of
in.
you.
Yep.
San Diego, for sure, it's gonna make sense to do that because of the
Yeah,
cost.
unless the land is depending on, I guess, where it is, but that would be the only thing.
All right. So anything else to add on this super helpful tax meeting sheet?
No, I think that's the majority of the things on here. I will say, I guess, this this does not matter if you don't know your numbers for the year. So if you have a business and you don't know what your profit's going to look like, then a lot of these things you don't really know if they're going to be helpful or not. So it is important to make good projections for the year based on previous years, based on what your goals are. I know it takes time. Every single client I have at one time or another has said, "Well, I don't know what it's going to be like next year because it always changes." And I never accept that from clients because we can't do tax strategy if you just say I don't know. I say, "Well, I don't know what dollar amount to go after saving you. I don't know how much strategy to give you." And so I do have some clients that will just say, okay, I know it's going to be more than this, but we're going to say 500,000 is the amount of tax strategy we need. So you can do it that way, but I love getting a little more closer. I mean, I have clients who right now, unless they have a huge change in their income between now and the end of the year, they know to the $100 amount what they're going to pay in taxes in April.
That's cool. Yeah.
And so if we can do more strategy, obviously it'll get better. If they have an extra sale or, a loss of, revenue from some reason, then obviously that'll change it. But assuming things go the way that we've projected, and the way that they did in previous years, we have people who know right now approximately what they're going to owe.
Well, what's cool about that is knowing, okay, we do this in December, and then we can do this. Like you can still put money into retirement accounts before April, correct? And
That's
have
right.
them count for
Yeah.
2025.
HSA and retirement accounts are the things you can do after the end of the year.
What was that again? Retirement
The
accounts and what?
HSA, health savings.
HSA. I've done more research. Yeah, we talked about the HSA, the health savings account, and I did more research into that, and that was very helpful. Last show we were on, Greg told us how we could get a hot tub with our HSA, so make sure you check out that show. And I
Yeah,
may do it,
that's
not for a hot
a
tub, but
good,
I may do.
a good one, definitely. So I
Well,
like that.
and in that vein too, if you know you have to have a major surgery, like you can get strategic with
Yep.
HSAs and the
Yeah.
insurance. So
Yeah, I have a client whose son needed some scoliosis treatment. He has scoliosis, and so they piled in as much as they could to their HSA because the only way you get to deduct medical expenses is if you've contributed to the HSA or if the expenses are more than 7.5% of your adjusted gross income. And then you only get to deduct what's above that.
got it.
So if your adjusted gross income was the 100,000, you would have to hit $7,501 before you get to deduct the first dollar. But if you put it in an HSA, you get to deduct all of it, and then you pay it out of the HSA.
Yeah, and you don't even have to use that. You can take the like the HSA income in the future as well,
That's
which is
right.
what you were making that point.
Yeah,
So
I have some clients who are saving up their HSA because it grows tax free. You
yeah.
put it in, you get a tax deduction, and as long as you take it out for medical purposes, it is taken out tax free. So I have clients who will save receipts, save deductibles from big surgeries. Maybe they paid 20 or 30 grand over the past couple years. They get it piled up to that much in their HSA and they've paid that out of pocket. Then they reimburse themselves all at once. And then that's a really nice vacation or a car or a new rental property or, whatever they want to use it for.
Yeah, if I could find a doctor who would prescribe a real estate property as
Yeah.
as a a way to reduce stress, maybe like an
Yeah.
emotional support property. Uh, let's see if we can find some doctors that'll do that.
I mean, you are in California. You might be able to get that through in California. Emotional support property.
Yes, if anywhere. All right, I'm gonna stop sharing this. Let's bring you back. I got you.
Yeah.
We got the GT. Come on back in and
There we go.
perfect. Thank you for going through that. And again, when you hire Greg and you actually join the team there, he's going to run through this with you as well and use
That's
it
right.
as a tool to start the strategy. So, all right. Well, it's late there. Let's end this now. But before we go, who needs a tax strategist? Like if you just graduated from college, my guess is you don't need one. But who's the best client that would take advantage of your services?
Yeah, so for us, it's typically going to be the people that have about $1 million in revenue per year. Um, but we work with a lot of people who are high W-2 earners who want to save because of they want to use like short-term rental loophole or things like that. So generally it's going to be those people that have some profit coming in. Typically over six figures in profit coming in per year.
Okay. And you do everything. Like you go soup to nuts if needed. So you got people who do bookkeeping. You got IRS enrolled agents there to help. You got CPAs, so you could do taxes. But more importantly, and I've said it 1,000 times, is the tax strategy. That to me is the biggest thing, because if you're not like we're all out there making money, we're all experts in our respective fields to make money. You are an expert in saving us money, and
That's right.
that's what we need, is that expertise.
Yeah, that's right.
So, all right. So we got a QR code you can scan. That'll take you to Taylor Tax Strategy, and you can sign up for a no obligation appointment there. We encourage you to do that. Greg, really appreciate you being here. I'm not going to see you before Thanksgiving, so have an amazing Thanksgiving, my friend. Enjoy that
Yeah.
time. So,
Yeah. Happy Thanksgiving to you and all the listeners as well.
actually, you know what? I lied. I'm going to see you next week for our meeting, but
Okay.
not everybody else here is going to see you. So happy Thanksgiving. All right. Thanks for being here, bud. Really appreciate it.